A major voice in finance, Paul Tudor Jones, known for predicting the 1987 crash, recently made a bold claim. He says the stock market could fall to new lows even if tariffs on China are cut in half. Why? Because these tariffs, according to him, are basically the biggest tax hike we've seen since the 1960s. He thinks this alone could slash economic growth by 2 to 3%. Now that warning isn't coming out of nowhere. The latest trade data shows the U.S. trade deficit just hit a record $140 billion in March. That was fueled by a rush to import goods before new tariffs kicked in. And that rush helped push first quarter GDP into negative territory. Let's talk about what this means and where the markets could be headed. Ted Oakley has been managing money for decades. He runs a major wealth firm and advises high-net-worth families. Right now, he's keeping half of his portfolio in cash. Why? He thinks both profit margins and valuations are about to drop, a double blow that could send stocks even lower. Oakley agrees with Tudor Jones. He believes the market's current valuation, trading around 21 times earnings, is just too high, especially with earnings set to decline. If both earnings and the PE multiple fall, it could easily drag the market to new lows. The big issue? Everyday investors aren't seeing it. Many are still putting money into the market, convinced it's a good time to buy the dip. But behind the scenes, the economy isn't looking strong. March's trade deficit wasn't just a fluke. First quarter GDP dropped 0.3%, and Oakley says what looked like strong spending was really just businesses and consumers front-loading purchases. That temporary activity made the economy look better than it actually was. Now signs of slowdown are emerging. Shipping volumes are down, ports are reporting less activity, oil prices are falling, a classic sign of economic softness. And while Wall Street stays obsessed with buying stocks, it's ignoring these red flags. Oakley warns that this disconnect between the data and investor behavior could be dangerous. Let's zoom out. Since Oakley's last big warning, the part of the economy that involves moving goods around, shipping, trucking, inventory, has tightened significantly. That's the real engine of the economy. And it's stalling. Meanwhile, the United States is starting to lose trust on the global stage. Oakley points out that it's no longer just one country that's upset with the US, it's many. That makes things more fragile. And here's the kicker: surveys show retail investors are more bearish than they've been in years, but they're still pumping money into the market. In April, individual investors put in $40 billion, the most in 5 years. Why? Many believe the Fed will always step in to save the day. But Oakley warns, if stocks keep falling, the same people buying now may panic and sell at the bottom. He's not buying the dip. Instead, he's watching closely and only buying companies when their prices truly make sense for the long run. Right now, he says, most companies are expensive. He screens about 250 companies and says only a handful are priced fairly. However, he has picked up a few. Recent buys include fertilizer stocks like Nutrien and Mosaic. He also bought food giant Unilever and pharmaceutical firms AbbVie and Novartis when their prices dipped. Another example, a small gold company called New Gold, which he says is trading at about 3.5 times its projected 2026 cash flow. Very cheap by most standards. He's also holding on to gas pipeline companies paying 8 to 9% yields. But he's avoiding the big-name tech stocks, what some call the Magnificent Seven, except for Microsoft. The rest he believes are overpriced and vulnerable. Now if earnings for the S&P 500 drop to $240, and the valuation multiple falls from 21 to 16, we could see the S&P drop to 4,000 or lower. And the market rarely stops at round numbers. It could go even lower before it bottoms. That's why Oakley waits for real value. He'll only buy when a stock looks good over the next 5 to 10 years, and if prices fall more, he's ready to buy more. Meanwhile, companies like Mattel are already raising prices before tariffs even hit. That's a sign of inflation that won't go away easily, and this is where the Fed has its hands tied. If inflation is still strong, the Fed can't just cut rates to save the market like it used to. That Fed put investors relied on, it might be gone. Oakley doesn't rely on Fed predictions, though. He says they often get it wrong. Instead, he watches what the economy and the markets are actually doing. If the Fed does cut rates soon, it might be a sign they're seeing serious trouble ahead. As for gold, he likes it. He treats it like a currency hedge, not a short-term trade. He holds physical bullion long-term, and also trades gold miners when they're cheap. He recently added a small position in New Gold, and also owns major miners like Agnico Eagle and royalty firms like Royal Gold. Oakley thinks gold is smart insurance, especially if the dollar continues to lose value. and there's reason to believe it will. Other countries are starting to dump dollars and move into gold. Why? Because they don't trust the US anymore. After the US froze Russia's assets, other nations realized the same could happen to them, so they're looking to reduce their dollar exposure. We're seeing this play out across Asia. Several Asian currencies are rising fast while dollar demand weakens. Some analysts are calling it a reverse Asian financial crisis, a major shift in capital flows. Oakley sees this as a trend that's been building for years, and it could reshape the global role of the US dollar. He's also written about a key issue most families overlook: how retirees manage their wealth. He says people over 65 often hold too much of their money in stocks, 85% to 90% in some cases. But what happens if the market drops 50%? That's not just a number he pulled from thin air. It's happened before. If you're 70 today, and the market enters a lost decade like it did in the 2000s, you might not have time to recover. Oakley says you need to ask, how much cash or liquid assets do I need to avoid making desperate decisions if the market crashes? He uses that 50% number to help clients plan. If that kind of drop would force you to sell out of fear, then you're probably too exposed. He also says people are holding more stocks than ever. Right now, nearly 60% of family wealth is in equities. In 1982, it was just 8%. His point is simple: be cautious. Don't assume what worked the last 15 years will keep working. And if you've made a lot of gains, don't be afraid to pay taxes and rebalance. Better that than watching your gains vanish over 20 years of inflation. He also believes in letting kids figure things out before introducing them to family wealth. Many parents want to start the conversation when their kids are 14 or 15. Oakley thinks that's too soon. He says most kids aren't ready to understand money at that age. And, if they grow up knowing they're set for life, it kills their ambition. He prefers parents wait until kids are in their 30s, after they've worked, struggled, and learned to stand on their own. Only then, he says, do they truly appreciate what wealth means. If you got value from this breakdown, make sure to like the video, leave a comment with your thoughts, and subscribe to the channel. We dive deep into market trends, investing strategies, and long-term wealth insights. So if that's your thing, stick around. Thanks for watching.